The main mistake in this entry was that I entered the market before the previous day high was taken. Because I didn't wait for that liquidity to be swept, the trade ended in a loss. My next entry was based on the following logic. London swept the previous day's high, taking all the buy-side liquidity. Right after that, the market formed a bearish fair value gap, and 4 candles failed to make a higher high. They were holding in the same area without any bullish expansion. Without waiting for the bullish fair value gap below to turn into an inversion fair value gap, I opened a short position immediately, risking $255. At the same time, I placed a second sell limit order at the level where the bullish fair value gap would become an inversion fair value gap once broken. The idea was simple: if the price moved down, I would have 2 active short positions. The first take profit was set just below the London low, which formed at the session open. Originally, I planned to place the second take profit under the Frankfurt low, but then I realized I did not want to hold the position that long. Instead, I chose a more conservative 1 to 3 risk to reward, placing the second target slightly higher, at the first logical zone where I expected price might bounce upward. When the trade reached a 1 to 1 risk to reward, I lowered my stop loss slightly, allowing for roughly a $150 maximum drawdown. But when the trade reached approximately a 1 to 1.5 risk to reward, I tightened my stop loss into a small profit of around $100. Shortly after that, the price finally hit my first take profit level. Without waiting for the second take profit, I continued trailing my stop loss lower and lower. When the price came very close to my stop, I pulled it even tighter. It was a very sensitive stop, so to speak, and the market eventually stopped me out just a few points before reaching TP2. I made $470 profit, which fully covered my previous loss.